partnership changes. A partnership is said to have changed when, first, partners agree to change the profit and loss sharing ratios. Second, a new partner joins a firm. Third, an existing partner retires. And fourth, the firm is dissolved. Change 1. When partners agree to change the profit and loss sharing ratio. The partners may decide to change the profit and loss sharing ratio at any date. All the profits and losses must be shared in the old profit or loss sharing ratio before and up to that date. However, subsequent to that date, the new ratio should be applied. Both realized and unrealized profits or losses should be shared. Realized profits and losses are those that are revealed by the income statement. Unrealized profits and losses are those that are made but not yet realized through a transaction. For example, profits or losses that arise from the revaluation of assets and liabilities when a partnership change has been instituted. These will result in adjustments to the partners' capitals. Goodwill is another example of an unrealized profit. Let us look at an important account that is opened when changes in partnerships are instituted, the revaluation account. A revaluation account is opened when assets and liabilities are revalued at the time of a change in a partnership. The profit or loss on revaluation is then transferred to the capital accounts of the partners in the old profit-sharing ratio. Here is an example taken from my book, Revising AS Accounting, a study guide. Malcolm and Peter are in partnership, sharing profits and losses in the ratio of 1:2. Their financial year ends on the 31st of December. On the 1st of July 20x3, they decide to change their profit-sharing ratio to 2:3. Their statement of financial position at 31st December 20x2 is given below. Study it carefully. The partners decide to revalue their assets at 30th June 20x3 as follows. Property, $100,000, which is an increase of $20,000. Motor vehicles, $10,000, which has decreased in value by $2,000. Furniture and fixtures, $8,000, which has decreased in value by $1,000. Inventory, $20,000, which has increased in value by $2,000. Trade receivables, $7,000, which has decreased in value by $1,000. Let us look at the solution. Journal entries have to be passed to revalue the assets. Property and inventory are both debited with the increase in the values of these assets. Property, $20,000, inventory, $2,000. Furniture and fixtures, motor vehicles, trade receivables are credited with the decrease in the value of these assets. Furniture and fixtures, $1,000. Motor vehicles, $2,000 credited. Trade receivables, $1,000. The revaluation account is then credited in this case and is the balancing figure, $18,000. Let us look at the second journal entry. The revaluation account is debited $18,000 and therefore closed, and the capital accounts of Malcolm and Peter are credited with the profit on revaluation in their all profit-sharing ratios of 1:2, Malcolm's capital account is credited with $6,000 and Peter's capital account is credited with $12,000. Let us take a closer look at goodwill. So what is goodwill? Goodwill is an intangible non-current asset. It is the difference between the purchase price and the value of identifiable net assets. Therefore, goodwill is equal to purchase price minus the value of identifiable net assets. It is calculated when there is a change in a partnership. Goodwill is shown as an intangible non-current asset and is listed before the tangible non-current assets in the statement of financial position of a business at the end of the financial year. However, most businesses write off goodwill in accordance with the concept or principle of prudence. In such a case, goodwill will not be shown. Let us look at the journal entries to be passed if A. The firm decides to maintain a goodwill account in the books of account. In such a case, the goodwill account is debited and the capital accounts of the old partners in the old profit-sharing ratio are credited. Note: the goodwill account will remain open and goodwill will appear in the statement of financial position as an intangible non-current asset. Now let us look at the journal entries to be passed B. The firm decides not to maintain a goodwill account in the books of account. The first entry that will be passed is the goodwill account will be debited and the capital accounts of the old partners in the old profit-sharing ratio will be credited. The second journal entry that has to be passed is the capital accounts of all the partners in the new profit-sharing ratio is debited and the goodwill account is credited. Note: the goodwill account is opened and immediately closed. Therefore, goodwill will not appear in the financial statements. Let us now look at change 2, the admission of a new partner. This example has been adapted from a past paper. Pause the video and study the example very carefully. Let us now look at the solution. Working 1. The share of the profits on revaluation. The profit on revaluation is $21,000. Hence, Jack and Kelly will share it in the old profit-sharing ratio. Jack will get $6,000 and Kelly will get $15,000. These appear on the credit side of Jack and Kelly's capital accounts. Working 2. Goodwill that is shared in the old profit-sharing ratio and therefore shown on the credit side of the capital accounts. The goodwill is $52,500. Jack's share would be $15,000 and Kelly's share would be $37,500. This goodwill of $52,500 shared in the new profit-sharing ratio and shown on the debit side of the capital accounts will be Jack's share $10,500, Kelly's share $26,250, and Liam's share $15,750. Working 3. Capital refunded to Jack and Kelly are as follows. Jack $19,500 and Kelly $37,250. These will appear on the debit side of Jack and Kelly's account. Liam, however, will have to bring in cash of $51,750 in order to ensure that all the capitals are in the ratio of 2:3:5 and that their total $120,000. Change 3. Retirement. This is an example taken from a past paper. Pause the video to study the example and the information given very carefully. The solution is on the next slide. Solution 1. Statement to calculate profit or loss on revaluation. There is a surplus on revaluation of premises of $29,000. There is a deficit on revaluation of inventory of $1,200. Therefore, the profit on revaluation is the difference between the two and is equal to $27,800. 2. As Bilal is retiring, his capital account will now have to be closed. Let us look at the credit side first. The balance on Bilal's capital account was $48,000. This is now brought down. Bilal's share of goodwill would be 2/5 of $85,000, which is equal to $34,000. Bilal's share of profit on revaluation is 2/5 of $27,800, which is $11,120. Let us now go to the debit side. Bilal had a debit balance on his current account of $1,200, which is now transferred to his capital account. As was agreed, $20,000 is paid immediately to Bilal. As part of the final settlement, Bilal is entitled to retain one of the motor vehicles at a valuation of $11,400. Therefore, the remaining on Bilal's capital account of $60,520 is now transferred to a loan account as per the final settlement agreement. Bilal's capital account is now closed. Notes: when a partner retires, the balance on his current account, if any, is transferred to his capital account. If there is goodwill, he is given his share of goodwill. The capital account is then closed after the balances, if any, are paid to the retiring partner. Note 2. Sometimes a partner leaves a part of his capital as a loan to the business. The loan amount is taken out of the proceeds paid to the retiring partner and transferred from his capital account to a loan account, in this case $60,520. Change 4. Dissolution of a partnership. When a partnership is dissolved or ceases to exist, one of the following two methods is used. First, all the business's assets and liabilities are sold to the new business. Some of the assets may be taken over by one or more of the partners. Some of the liabilities may be paid off. A realization account is opened to record all these transactions. Alternatively, the assets may be sold to many different people and the money used to pay off liabilities. The partners then retire and the balance in the bank account is transferred to them. The partnership is then, therefore, dissolved. Let us look at the steps that have to be taken. Step 1. Open a realization account to record the sale of assets. Study all the entries that have to be made carefully. Step 2. Cash paid and received. Cash may be received from trade receivables or may be used to pay creditors and the expenses of dissolution. Payment of creditors, trade payables will be debited, bank will be credited. Cash received from trade receivables, bank debited, trade receivables credited. Repayment of partner's loan account will be debited and bank account will be credited. Step 3. Finally, the balance of cash is used to repay the partners for the balance on their capital accounts. Repayments of partners' capital accounts. If there is a credit balance, the partners' capital accounts will be debited and bank will be credited. B. If there's a debit balance on the partners' capital accounts, bank will be debited and partners' capital accounts will be credited. Step 4. All the accounts should now be closed. Note: a realization account is used to close the books of account on the dissolution of a partnership, whereas a revaluation account is used to record changes in the value of assets and liabilities on changes in a partnership. This is an example adapted from a past paper. Wang and Yuan, who share profits and losses in the ratio of 2:1, decided to dissolve their partnership. Their summarized statement of financial position at 30th September 2015 was as follows. Study the statement and the additional information given carefully. The solution is on the next slide. Solution. Let us draw up the realization account by transferring the non-current assets of $70,000 to the debit side, the current assets of $30,000 also to the debit side, and trade payables $26,000 to the credit side. Let us now see what these have realized. Land and buildings realized $70,000 recorded on the credit side. One motor vehicle was acquired by Juan at the value of $3,000 also recorded on the credit side, and the other motor vehicle was sold for $3,500, which is recorded on the credit side again. Trade receivables realized $15,000 and inventory realized $12,000. Let us now go to the debit side. As per working one, trade payables were paid $24,500. The dissolution costs were $1,700. The balance is the profit on realization divided between Wang and Juan in their profit-sharing ratios. Wang therefore gets $2,200 and Juan gets $1,100. Both of these are transferred to their capital accounts. Let us now calculate the amount due to each partner when the bank account is closed on dissolution. Let us look at Wang's account first. His capital account balance was $40,000. He had a deficit or a debit balance of $10,000 on his current account, and his share of profit on realization was $2,200. Therefore, the amount due to Wang is $32,200. Let us now look at Juan's account. The balance on his capital account was $25,000. He had a credit balance of $13,000 on his current account. Share of profit on realization was $1,100. However, he acquired a motor vehicle at the value of $3,000. Therefore, The amount due to Juan is $36,100. More information about AS Accounting, a Study Guide. The content of this book matches the latest CRE AS syllabus and is pitched at a level that is extremely workable. The book is written by a qualified and experienced teacher and fills the need for a guide that is solely meant for the CRE AS Accounting course. Some salient features of the book are: it unpacks the CRE AS Accounting syllabus, IAS terminology has been used, students love the unique question and answer presentation of theory, there are numerous tips for success, and exhaustive exercises for practice. This book is available at most book outlets worldwide, including Book Depository and Amazon. They are available in hard copy as well as in e-book format. Here are other titles available: AS Accounting Workbook, a write-in workbook that will help you prepare for your examinations, and Revising A-Level Accounting. Please contact me at junebaptista@hotmail.com for more information and for answers.